Welcome to the Recruitment Leadership Podcast, hosted by Alison Humphries. The Recruitment Leadership Podcast is here to help those in the recruitment industry gain awareness and understanding on the hot topics faced by those in the business of hiring people. In each episode, Alison Humphries is joined by a fellow expert to offer professional knowledge, insight and advice on the biggest subjects affecting recruitment businesses. It's the podcast to listen to for recruitment business frontrunners seeking expert information from industry-leading advisors. Welcome to the Recruitment Leadership Podcast.
Hello and welcome to the Recruitment Leadership Podcast. I'm Alison Humphries. Thank you for joining us again. And we've been tracking tools and techniques that could really make a difference to your business in the current economic climate. Today, I'm delighted to be joined by Mark Overend of Ascentis LLP. So the last podcast, I was chatting with Mark's colleague, John Oddy. And Mark, you're the tax partner at Ascentis, and you've joined there originally from Deloitte, having spent some time in the mortgage advice industry. But now you specialise purely in giving specialist tax advice. So I'm sure lots of our listeners are going to be very interested to hear what you have to say. And outside of work, Mark, I think you're a bit of a runner, aren't you?
I am, yes.
Okay. So how good are you? You mentioned you'd done a half marathon recently. What was your time?
1 hour 50. So I suppose I'm midfield, I guess. I'm not flying around at the front of the pack, but I try not to be right at the back.
Listen, I take my hat off to anyone who can do a half marathon. I started doing one of these Couch to 5K programs at the beginning of lockdown, and I was so pleased with myself. I was so pleased with myself that 10 weeks in, I gave myself a stress fracture, and all of my good work has been undone ever since, as I've been completely unable to do any exercise since then. So well done to you for getting that far. So what we're going to talk about today, for the benefit of our listeners, is basically breaks down into 3 sections. One is a general, what all recruitment business owners should have considered and put in place if it's appropriate. Part 2 will focus on those business owners who, sadly, because of the nature of the virus and the sectors that they have recruited in, have been really badly hit. So there are going to be some, let's call it tax tidy-ups that, Mark, I know you want to talk about there, some more defensive actions, if you will. And then in the final section, we will focus on those businesses who have either been lucky enough to be in a very buoyant sector or are looking to diversify and grow with a program of investment and the kind of things that they can do. So 3 distinct sections. And so, Mark, if I can start with an opener for recruitment business owners who have already got that financial visibility and control that we were discussing with John in the last podcast, what are the general tax planning pieces that you think all recruitment business owners should have in place right now? Could we just start there?
Sure. I mean, usually the first question I get asked by recruitment business owners who I meet is my remuneration as tax efficient as possible? Usually that constitutes taking a modest level of salary through your payroll. This year it's £732 a month. And then taking the rest of your money, your remuneration as dividends. The vast majority of business owners usually have that in place already. If you don't, it may be because you're just starting up and you haven't got the profits yet to pay dividends. And if not, then you're probably just paying yourself a salary and you'd be looking at moving towards the dividend position as your business gets itself into a sure footing. Once we moved away from standard remuneration, then we tend to...
Actually, just before you do move off that, Mark, can I ask you a question? So 2 situations that I think have sort of bubbled up for a number of people that I know recently who are recruitment business owners. So number 1 is that when the market sort of collapsed and fell off a cliff in April, many of those business owners who were paying themselves largely in dividends found that they were suddenly, because there was no, help out scheme, furlough scheme for them, other than for that very low salary they paid themselves, suddenly found that they were earning considerably less than their staff, even those staff who were furloughed. So are you still happy that this is the best, most efficient way for all recruitment business owners to take their reward?
Under normal circumstances, yeah. I mean, the recent situation is obviously incredibly exceptional circumstances whereby, businesses have found that they've basically been completely shut down overnight. It's very difficult to plan for something like that. And I know that the vast majority of our clients have found it very difficult where they've, as you say, their staff have been earning more than they have through the furlough scheme because they haven't had the salaried remuneration to fall back on. As we move away from, the government support now, which is due to end on the 31st of October in full, and we go back to a more normal landscape, then purely from a tax point of view, it remains the most tax efficient way to pay yourself a small salary and the remainder as dividends. So, yeah, for me, it feels like that it's still the right thing to do.
One of the reasons that some of the people I know were a bit shocked by this scenario was because they have treated their dividends as salary. In other words, they have routinely drawn the same amount of dividend on a monthly basis and then maybe a little bit extra after they've finalised their accounts. Is there a risk? How frequently would you expect to see people drawing dividends in a small recruitment business, let's say sub 20 staff?
Well, the way we deal with our clients is that we are aware that a lot of people who run businesses perhaps have come from an employment background in the past and they're just used to receiving a regular monthly amount. And dividends, of course, are actually a distribution of profit, not really designed to be used as a salary. They're supposed to be a distribution of profits, perhaps declared twice a year or quarterly. And so what we try to encourage our clients to do is to sit down with their financial information and actually declare their dividends in advance, usually on a quarterly basis. So they'll look at the quarterly management accounts, project forward what they're going to do in the business, understand what the profit levels are going to be based on those projections and past results, and therefore decide on the level of appropriate dividends and declare those. Once they're declared, they can then draw them down from their director's loan account on a monthly basis. So if you're declaring if you want to take £10,000 a month out of your business, you can declare £40,000 in advance and then draw down against it. That's the best way to approach these things. And it then gets you away from the mindset of it actually being a salary and gets you more into a business owner mindset of managing your financials on a more regular basis, actually taking a holistic view of the business of where it's going, doing wider financial planning alongside your tax planning as well.
Yeah, I think that's a really good point because so many people have never mentally made that leap until they were forced to by COVID, actually. Anyway, sorry. So just to park the pay and dividends piece, I think you were going to go on and say something else about pensions.
Yes. So once you've got your remuneration settled, if you're fortunate enough to be in a position where there's then additional cash reserves in the business that you'd like to potentially draw out, but you don't necessarily need to use them to spend immediately, we usually encourage clients to look at pension planning. An individual can put up to £40,000 a year into a pension, and where a company makes a pension contribution on behalf of a director or an employee, the company gets a corporation tax deduction, where, of course, dividends being a deduction of post-tax profits, there's no corporation tax deduction for drawing dividends. So usually a good remuneration strategy should also encourage the use of pension contributions. And again, you need to sit down with your financial information to understand what level of pension contributions the company can make on your behalf. Some people like to do a monthly amount. Other people like to do, sit down with their annual accounts at the end of the year and perhaps do more or a rather larger lump sum. But being able to build that pension nest egg for the future, for retirement or for other investment vehicle opportunities is hugely important.
I know, obviously, as you'll be aware, the recruitment industry has quite a young age profile typically. And I know business owners who have been really successful, worked very hard, and have got the money to invest in their pensions at the end of the year. But it seems a very, very long time to them to lock their money up. So, and they're wondering whether they'll be able to get their hands on it if there is a turnaround, as there has been. And what's your advice to those people about locking their money up in a pension?
Well, I suppose I have to be very careful, first of all, not to give actual pensions advice because I'm not a regulated pensions advisor. But it's generally, from a tax point of view, my advice is usually one that the corporation tax deduction is very attractive for transferring the money out of the company. So there is a short-term benefit in reducing your corporation tax bills. And the other is that pensions can be used for things other than just stock market investments, which can fluctuate up and down. And as you say, it can be quite unappealing to those who are quite young and see the age of 55 where they can first access the pensions as something that's a long way off in the future. For ambitious business owners who are perhaps looking to buy premises in the future, they can convert their pensions into a SIP or a SAS structure and use that pension structure to buy a building, perhaps office space in the future, that as they grow, they could move into that. If they were to use that opportunity, then potentially in the future their pension could own the building. The business would then be paying rent to their pension, creating a very tax efficient structure whereby the business is funding even more money into their pension because the rents go directly to the pension. Effectively, you are your own landlord, albeit by way of your pension owning the building that you occupy rather than a third-party landlord.
Right. Okay. So let me just make sure I've understood what you're saying, that if the pension is in a SIP, a self-invested pension plan, then it can be used long before the age 55 cutoff to, for example, buy an asset like a building that then generates more income. Yes?
Yes.
Okay. And drawing that down to spend on, say, buying a building, does that then attract the tax that's been avoided by putting it in the SIP?
Well, the SIP itself is the one that buys the building, so there's no drawdown of the pension. The SIP
right.
is a separate corporate entity in its own right, so it would buy the building.
Yeah.
And any growth in value of that building over time is tax-free because pensions don't pay capital gains tax. The only real tax cost is the stamp duty of buying the building in the first place, which is something.
Yeah, so it's an interesting one, isn't it? Because we see commercial office buildings being emptied out at a massive scale, on a massive scale at the moment. And it's a little bit of a speculator's market at the moment, isn't it? Because nobody knows whether people are going to return to traditional ways of working. But I would imagine there's going to be some bargains to be had in terms of commercial office space.
I would imagine so, yeah. And it's going to be an interesting time to see whether people, how do you want to run your business? Do you view the office space as a necessity, or do you view it as a burden? For those businesses that view it as a necessity, then it's going to become a buyer's market by the sounds of things, as we read in the press.
How else can you use, for example, business funds via a pension or not to buy assets that are more tax efficient?
Well, companies can own assets themselves. In terms of tax efficiency, I suppose one thing that clients are often quite keen to understand the most tax efficient ownership of is cars. And if we go back maybe 10, 15 years, a company car was almost a must have because it was just a no brainer to have your car owned by the company and let the company pay all the bills, and a very small tax charge was incurred. Over the last number of years, successive governments have tried to change that position, basically on the back of a green agenda, wanting to make it more environmentally friendly to own things like electric cars. Petrol cars have suddenly become very expensive from a tax point of view to have through the company. And it almost went to the point where tax advisors are saying don't have a company car at all. More recently, with the green agenda and electric cars becoming more common, there's actually a great opportunity at the moment to obtain an electric car through the company as a private vehicle. The company can obtain 100% deduction of the cost of the car if it's bought. And the tax charge for the director or employee using the car currently in this income tax year is 0% for a fully electric brand new car. And next year is only 1% of the list price of the vehicle. So very small tax charges. So if there are lump sums around or cash available for assets, then certainly a company car, if it's fully electric, could be something that's tax efficient to acquire.
Now, I know that lots of our listeners are going to be very interested in this, so let's get really specific here. What I think you're saying is that if you are a company director and the company buys the car, you can knock off the entire cost of it against tax. Is that right?
Yes, in the year that it's bought, yes.
Right. So in effect, you can deduct the cost of that from your profits for corporation tax purposes.
Correct, yes.
Right. And then the tax charge that you incur as the individual who is using that car is zero in the first year.
In this income tax year up to the 5th of April 2021, yes.
Right. So it's my word, I mean, that is almost a no-brainer, isn't it, for anyone who's happy with an electric car? And have many of your clients actually gone ahead and done this?
I was going to say it is a no-brainer. It's a bit of a no-brainer. A number of our clients have gone down that route, yes. And it's interesting to see there's quite a wide variety of electric cars on the market now that, immediately the one that springs to mind is usually Tesla because they're pressed so much, but companies like Jaguar have the I-Pace now, and there's all sorts of other options out there that BMW have got a good one, and a number of our clients have got all sorts of vehicles now, and we generally get very good feedback from the driving experience they've had as well.
Right, okay. So the only drawback then is to actually make sure that you learn to go plug your electric car in regularly. If you're not used to that, that's quite difficult. But you can't do that can you do that for employees?
Yeah, the same rules apply for employees as they do for directors. It's across the board.
Right, okay. So I think there'll probably be a number of our listeners keen to do that. Now, if I can just ask you to turn your attention to, sadly, those people running businesses that were heavily committed into one market, and just because of the nature of this very specific virus, that market has disappeared. I mean, hospitality would be a classic example, and hospitality recruitment has, through no fault of those business owners, has really taken a very, very heavy hit. Now, for those business owners who do find themselves in that position, while they are going around wondering whether to bring their staff back, and what markets to move into now, what are the tax areas you would advise them to tidy up and make sure we're most efficient straight away?
Sure. I mean, the first thing is to loop back to remuneration. Where people are taking dividends, which is, of course, a distribution of profits, they should be very close to their financials right now and making sure that they do have sufficient profits to continue to pay the dividends that they're likely to still want to take. If they don't have the sufficient profits and they continue to draw the money, one negative consequence of that can be that they end up with what's called an overdrawn director's loan account, where there aren't sufficient profits to declare dividends. Drawings are posted in an accountant's world to what's called the director's loan account, which means the company has effectively lent the director money that could fundamentally have to be paid back if there aren't profits in the future to declare a dividend to cover these loans. Several negative tax consequences to that and wider commercial ones. If we get to the end of an accounting year and a director has an overdrawn director's loan account, there's what's called Section 455 tax, which causes a 32.5% corporation tax charge to be placed on the amount of the director's loan account that's overdrawn. And that tax charge has to be paid if the loan remains outstanding 9 months and 1 day after the year end. So that's quite a costly tax charge. Now, that tax charge can be returned to the company when the director's loan account is repaid. Obviously, very negative from a cash flow point of view to have to pay that.
At the worst possible time, yeah.
Exactly, yeah. If the loan account is overdrawn by more than £10,000, then there's a P11D benefit in kind if as an interest-free loan to the director. Those tax charges are relatively modest and obviously depend on the level of the loan account. But still, again, a negative tax consequence that is good to avoid. And the wider commercial consequences, if of course the business, the worst were to happen to the business, if it were to end up insolvent, an insolvency practitioner is required to bring in all the debtors on the balance sheet whenever a company goes insolvent. And if a director's loan account is overdrawn, that is a debtor at an insolvency point of view. And an insolvency practitioner would have to call in that debt, which could be catastrophic for the individual concerned if they don't have the cash to repay it.
So I think there's an important lesson there, isn't there, that if you have treated dividends as a salary, just stop doing that right now and start taking a more active look at the P&L before you draw down any more money from the business. And in terms of things like seeking time to pay arrangements with HMRC and furlough money, loans that have been taken, any general points for recruitment business owners?
Well, I suppose general points, time to pay arrangements for any tax debts are easier to get at the moment with HMRC. They're being very lenient with all business owners at the moment. Usually it would be very difficult to even get to 12 months on a time to pay arrangement, but they're openly discussing 2-year time to pay arrangements with a couple of clients that we've been assisting in that area.
And in that case, obviously without naming names, what are the criteria that those companies have fulfilled to get such a generous time to pay arrangement? What are the checks that HMRC has done on them that they've satisfied?
Well, the biggest check that we've come across to date has been that making sure that you've paid your PAYE and national insurance during any period of furlough claim. That seems to be a real 3-line whip that HMRC have put out there, that if you've not been paying your PAYE whilst been claiming furlough money, because the PAYE is included in the furlough money that you're receiving, HMRC is really taking a dim view of that. So if you've been making your PAYE payments in full and on time whilst receiving the furlough money, then you're over the first hurdle. They then seem to be open to discussion on your business case. Obviously, they always take these on a case-by-case basis. So if you've been adversely affected and you can put forward a good business case and you've got a good proposition for them, then at the moment they seem willing to listen to what you've got to say.
So could you give us an example of a good business case in this context that perhaps some of our recruitment business listeners can relate to? What kind of things do HMRC want to hear about what's going to happen in the future?
Well, they want to hear that they're going to get paid fundamentally. So they want to hear that you're able to meet ongoing liabilities as well as being able to catch up the debts that you've accrued over whatever period that has been. You know, the justification, the business case is fairly straightforward. We all know what's happened recently, but it's proving that you've got some financial forecasts that you've done that prove that you've got the cash flow ability to actually meet your ongoing commitments. If you're able to do that, then HMRC are very comfortable with things.
So how granular do HMRC get when you show them those forecasts? Because, you know, a forecast could be just wish fulfillment, couldn't it? How much checking are they going to do on that?
I mean, they're not going to go into, they're not going into forensic accounting areas with the vast majority of small business owners that we deal with. They're just looking for the fact that you've actually done some work to justify what you're saying to them, and that you've justified, you've not just plucked a number out of the air and tried to get away with it, if you like. You've done some work to work out exactly how things are going to go forwards, and you can prove that you've got some justification to the proposition you're making for them, then they're generally in a position that they want to work with you on that.
Okay, so let's imagine then that I am a recruitment business owner, and the majority of my business in the past has been in the retail and hospitality placements. And so my time to pay case is based on my assessment that my clients are going to start returning and recruiting from September onwards. And I've put some sales forecast figures in based on that. I mean, is HMRC going to ask me for details of my client contacts or how I've made that estimate, or are they just going to take that based on my industry expertise?
No, they'd rarely ask for justification at the level we operate. Certainly, they're usually more than happy to receive. I mean, effectively, time to pay arrangements where we've got into that level, usually a spreadsheet forecast that we send them with the financials on. For their purposes, I've never been asked to justify the names of customers underneath or anything of that nature.
Right. And in terms of what we were talking about earlier, directors' dividends, if they were looking at giving you time to pay based on future forecasts, what view would HMRC take of a business where the director had not taken, was still expecting to draw the same out in dividends as they did pre-COVID, in your view?
I mean, HMRC would normally expect you to have exhausted all avenues of other finance before you approach them for a time to pay arrangement. They don't, however, expect you to bankrupt yourself. So they understand that as a business owner, you've got to earn a living. As long as your remuneration, if that's taken as a salary and dividends, is commensurate with what it would normally be, they don't seem to take great exception to that.
There are going to be businesses that obviously end up with a a loss, a net loss at the end of their financial year. And what position does that put them in with regard to corporation tax? And are there any ways of mitigating that problem?
Yeah, so if a company makes a loss for corporation tax purposes at the end of its accounting year, the best thing it can do from a cash flow point of view is carry that back to the previous 12-month accounting period and offset that against the profits presumably made in the previous year. And where there are profits that the loss can be offset against, you can claim a corporation tax rebate. At the moment, HMRC are prioritising corporation tax refunds to try and get them out to business owners as quickly as possible. And so if you find yourself in that position, the best thing to do is get your accounts and corporation tax return completed as quickly as possible and get the corporation tax return filed with the claim to carry the loss back to the previous year to get that refund into the bank account as quickly as possible.
Right. So specifically then, if my last tax, this is hypothetical, but if my last tax year ended December 19 and I made, 300k net profit, and so I wouldn't actually have paid my corporation tax on that yet, or maybe a little bit on account. But this year, we get to the end of this year and I've made a loss, then I basically put the loss back into 2019. That's what you're saying, and get a rebate on that tax. Yes.
Effectively, yeah. Obviously, if you haven't yet paid it, then it may just mean that you don't have to pay that 2019 tax, or you pay a reduced amount. But if you have paid your 2019 tax, then yes, you get a rebate from it.
Okay, great. Right. Well, that will give some people some relief. But there are I'm delighted to say, a number of recruitment businesses. Obvious sectors would be healthcare and energy, where recruiters have been absolutely flying and, if anything, have seen an upturn in demand for their services. There are others who've got the reserves that they're now able to look into diversifying into new markets. And for some, this will be, okay, I've come through that okay, but I feel now is the time I want to exit the industry. So things that we haven't covered so far that from a tax point of view, those businesses should be thinking about now, I guess, would include things like EMI schemes. Can you tell us about those? And because I have to say, there's a lot of misinformation about EMI schemes out there. For example, I met with a new client fairly recently who had been told that if they were to start an EMI scheme, then every member of staff that they had, and bear in mind this was a 6-month-old business, would have to have an equal share in their business. Now, I don't know who had told them that, but it's probably worth us taking a minute or two just for you to outline what an EMI scheme is and how it can work for a business that's trading well at the moment.
Sure. Well, I suppose the fundamental underlying reason to do an EMI scheme is a share option scheme. So if you've got senior members of staff or team members who you want to really keep hold of, and pay is not necessarily the way to go, then if you want to try and give them equity in your limited company, then setting up a share scheme is usually the way to do it, because you can't just gift shares to an employee without an income tax charge arising on them, or based on the value of the shares. And if you're a highly profitable, well-established company, that income tax charge could be quite significant. The employee's receiving shares, so they're not actually receiving anything physical money. And so an income tax charge will be rather unwelcome because they haven't got anything with which to pay it. The general way to avoid such an income tax charge arising is to use one of the several available share option schemes, as they're called. Now, tax schemes have generally had quite a lot of bad press over the past few years with what are generally known as abusive tax schemes, where people have tried to avoid tax with tax schemes that have been created by very clever individuals who try to manipulate the law. A share option scheme is not to be confused with that sort of tax planning. A share option scheme is written into tax law. It's something that the government has effectively said that you're allowed to do by saying, if you follow the rules that we've written in the tax law, then we will help you with lower tax bills. EMI, the one that you've mentioned, an enterprise management investment scheme, is one of the more popular ones because it allows effectively a company owner to grant share options to these senior members of staff. So you're making them kind of halfway house equity partners because they're not full shareholders yet. They can't receive dividends, they can't vote, but they've got an option to buy these shares in the future. They're sometimes known as growth shares because you tie the value of the share options into the current value of the company with a view to the employees being able to exercise these share options at some point in the future. That point in the future is usually determined by the business owners around a set of objectives. It might be a certain level of business performance based on profitability or turnover or a combination of the two. It might be tied to an exit strategy, perhaps in 5 years' time, or indeed simply an exit, i.e. when we find a buyer, you'll be able to exercise your options, benefit from that exit. The incentive for the employee is that it's massively in their interest to grow the business because they get the option. Perhaps your company is valued at £5 a share now. And so they're granted the option over these shares at £5. If they grow the business and then they exercise the option in the future when the company's perhaps worth £20 a share, they still only pay £5 a share. So they get that massive discount, but they've worked towards building that growth. The tax advantage is that being granted the share option doesn't incur an income tax charge. And indeed, when they come to exercise the share option, obviously they have to pay for the shares. So again, there's no income tax charge on that. It may be that they can't necessarily afford to exercise the share option. And that's usually where you're looking at structuring things around a potential exit, i.e. you just want people to benefit when the company is sold. And the exercise price can be rolled up and deducted from the proceeds that they get from the business sale.
Yeah, just a thought on that. I meet a lot of recruiters who start up a business, and understandably, they do so with the highest of intentions, and they want to run something that generously rewards their employees, often in a way that they didn't feel they'd been rewarded when they were an employee. And one of the issues that they quite frequently run into is from the best of motives, they give away through share options very large proportions of their business to people who are with them at the beginning. And people come, go, some people reach the limits of their capability or indeed motivation. And they've, and new staff need to come in, but at this point, the owner's got no more equity or options to give. So obviously they can hit a problem there in terms of bringing new people in. It is, of course, possible to bring people into a scheme on different conditions later on, isn't it?
Yeah, I mean, if you're going to go into a share option scheme, it's something we always try to have fairly lengthy discussions with our clients about because it's not something to be done lightly. I've come across many clients, similar to as you said in the past, almost overly enthusiastically dishing out equity in the early days to then fairly heavily regret it in the future because they look back and just sort of think, what was I thinking? It's very important to have a much wider commercial view of what you're doing, what you're planning. There needs to be a real plan around why you are giving people equity in your business and what you want to achieve from doing that. If you want your entire workforce to benefit from a share scheme, then EMI is not for you. There's other share schemes out there that can work for you and would be much more applicable. If you've got a few elite members of staff that you want effectively to either perhaps do a management buyout in the future or join you at the top table, if you like, or help really put the foot on the accelerator to some sort of exit, you're looking to get bought out by a bigger competitor in the market, then EMI is really going to help you deliver that by incentivizing your staff. So I think sometimes we get approached by clients who say, I want to do an EMI scheme. And it's because they've heard the name, not really because they've got a reason for doing it. Usually we kind of almost have a back to basics conversation with people who say, I want to do an EMI scheme, just to really get an understanding of what they want to achieve with it and to make sure that it's right for them. And if it's not right, we generally try and point them in the direction of something more applicable to them.
Right. Okay. So let's move on and talk about something that's just beginning to sort of bubble through in the recruitment industry, which is research and development tax credits. So the majority of our listeners won't have heard of these and won't know how they work. Can you just give us an outline, please?
Sure. I mean, in tax these days, there's very few magic wands that you can wave to remove a corporation tax bill or indeed an income tax bill. Research and development tax credits or tax relief is kind of the last bastion of legal tax reduction, that it makes a significant change to your tax bills. Any expenditure that qualifies for research and development tax relief is uplifted by 230%. So it's a significant change to your tax bill. Now, when you talk about research and development, the image that usually springs to mind is individuals in white lab coats, scientific experiments, probably trying to find an antidote to COVID-19 at the moment. But that's a very small part of what the research and development tax relief system is about. It applies to any step change in technology or technological processes. Now, recruitment consultants are probably thinking that's still not going to apply to my business because I don't deal in technology. Where we have applied it to businesses of that nature is usually around internal systems. So if you've got perhaps a CRM-based system that you use to manage your business, and for some reason it doesn't work for you, it doesn't quite do what you want it to do, and you get your IT team or your external IT consultants in, and you spend some money having your system development worked on, then you can potentially fall into the R&D regime. An example that we've done an R&D claim for in our client base was a client who generates leads via their website or various websites, and they had an off-the-shelf CRM system called Salesforce, which I imagine people are probably quite familiar with. And Salesforce did probably, 20% of what they actually wanted it to do. And they've invested several £100,000 over a number of years in developing Salesforce, making it very bespoke to their needs, having very unique aspects of technology added into it, creating new systemization and functionality within the system so that it worked in a very bespoke way for their business. All of that development work that they did has qualified for R&D relief and has saved them a couple of £100,000 actually. They've saved a huge amount of tax by having to invest in this technology to take their business forward.
Right. And what's the threshold of evidence that HMRC would want to see for that?
Well, the process of making an R&D claim is that you do it on your corporation tax return. There's a couple of boxes you fill in the corporation tax return, but the real body of evidence that you send is that a report is written that outlines the work that's been done for HMRC so that their inspectors can understand what it is that you've been working on in your business and why you think that the R&D relief regime applies to you as a business. We prepare these reports for our clients. They're typically quite long reports. They justify, the technological advance, the uncertainties that you've had to go through and all the steps that you've had to work your way through. Often when we're doing an IT-based system, there'll be iterations of code, testing, user interface, acceptance testing, things going between developers and office staff to get the functionality right in areas that they're, where they're really stretching the boundaries of the systems that they're working on. You just need to write the report up to let HMRC understand in the broadest possible terms what it is that you've been doing.
Right. Okay. So just to be clear then, it's something that needs to have there's an output, there's a measurable output and a process that you followed to get there. It's not a question of saying, for example, because there will be some listeners who are thinking maybe I could take advantage of this by saying that all my telephone calls have been research. But you're talking about there has to be some product or something tangible that is developed as a result of that.
It has to be new knowledge as well. It can't be something. Often, one of the client questions I get asked often is, I've got to go on a training course. Can that qualify for research and development? The acquisition of existing knowledge is not research and development for tax relief purposes. It might be for you and your business, and that's fine. That's great that you're learning more and expanding your knowledge base. Unfortunately, for tax relief purposes, it's not. There's got to be a step change in your industry, in what you're doing. Nobody else is doing it. That's the best way I can put it, really.
Okay, so I think that's an interesting one, not just from a tax point of view, but to be honest, for a lot of recruitment businesses who have been doing the same old, got any jobs, maybe need to have a good hard look at how they can actually develop their proposition using technology, or perhaps something that we haven't thought of yet. So just before we wrap up then, Anything else that you think, I know in our earlier conversation we touched on SEIS and so forth very quickly, just any notes that are relevant for someone who's heard of this and may be interested?
Yeah, so, Enterprise Investment Scheme or Seed Enterprise Investment Scheme, the two reliefs available for investors in a business. If you're looking, if you're one of the individuals who falls within the successful aspect of our conversation and you've got money that you're looking perhaps to invest in a new startup business somewhere, the schemes would allow you to get tax relief on the investment for Seed Enterprise Investment Scheme, up to 50% tax relief on the amount you invest in the company shares that you're buying into. For Enterprise Investment Scheme, 30% of the 30% of the amount you invest comes as a tax relief, subject to certain limits. On the flip side, if you're looking to start a business, start a new venture, and you're looking to attract investors, it's a really good idea that to see if you qualify for these schemes as a company and to register for pre-approval with HMRC. Once you've got that pre-approval, investors are far more interested in investing in your business, knowing that they can get this tax relief than knowing that you've done the research to make sure that they will be able to obtain it.
Okay, so just to be clear, if I were setting up a brand new recruitment business now, I can't make seed investment in my own business. It has to be from an external source, correct?
Correct. There's numerous restrictions on the various investments that can be made, but one of them is that if you are making an investment and want to claim this relief, the maximum shareholding you can have is 30%.
Right. So the claimer, who is the investor, can only own 30%. Right. Thank you. Okay. And you mentioned about pre-registering for approval. So how onerous is that process?
It's a process that needs to be undertaken by a tax specialist. It's a fairly bureaucratic form-filling exercise with you need to send business plans and prospectus and things like that. The application process, it's not one of the worst processes that you've got to go through with HMRC. Indeed, I actually did one for a company in the recruitment industry the week before I went on holiday, and HMRC responded astoundingly within 48 hours with an approval.
My word.
Yeah.
Must have been a very good submission, Mark, is all I can say.
Yeah.
Okay, but definitely engage a tax specialist for that. Okay, that's fascinating. Now, unfortunately, we've run out of time, but that has been very interesting in terms of very specific steps that people can take, some of which many of our listeners won't have considered before. So if they want to take the conversation about tax further with you, Mark, how do they contact you?
Well, if they want to visit our website, we are ascentisllp.co.uk, or they can email me. I am mark.overend@ascentisllp.co.uk.
Okay, thank you. And Ascentis, as I mentioned at the beginning, Mark's the tax partner, but obviously it's a full service firm. So I've been Alison Humphries. This has been the Recruitment Leadership Podcast. And if you are taking a look at refreshing your business, renewing it, entering new markets, tax is one element of all the professional advice that you will need. So again, do contact me. That's Alison at recruitmentleadership.co.uk. Mark, thank you very much for joining us today, and keep on running.
Thanks for having me.
Thank you.
You've been listening to the Recruitment Leadership Podcast. If you enjoyed our podcast, please subscribe, review, and share so that others can find the podcast too. We really appreciate your support. If you have any questions about the topics covered or wish to find out more about recruitment leadership, please email alison@recruitmentleadership.co.uk, referencing the podcast. We're also on LinkedIn, where you can follow Recruitment Leadership and connect with Alison Humphries. Thank you for listening, and we hope you join us next time for another episode of the Recruitment Leadership Podcast.